Big Pharma is in trouble, hidden by runaway examples like Eli Lilly and NVO, up more than 158% over the last 2 years, are others like BMY and Pfizer that have lost more than a third of their value, and the broader S&P Pharmaceuticals group, the XPH, is down almost 2% over the period. Fears of price controls on drugs have hurt, but it is a massive pipeline cliff that is punishing many of these stocks, and it is only going to get worse. It started with layoffs in the thousands at major drug makers, and now we're seeing a massive cut to spending on research and development. Charles River, a key supplier of drug discovery services to drug makers, shocked the market on its earnings report, expecting declining revenue and saying there are profound cuts at pharmaceutical companies. Pfizer announced an additional $1.5 billion in cuts by 2027 when it reported in May, on top of the existing $4 billion cost-cutting program from last year. Bristol Myers, ticker BMY, recently said it would cut 2,200 jobs this year and shave $1.5 billion out of costs through 2025. And why this is important? Because the industry is already facing a giant drop in revenues as patents expire. The top 20 pharmaceutical companies alone could lose $183 billion in sales through 2028. You see, when a new drug clears FDA trials, a patent or exclusive use for the company is given usually for around 20 years. But when those patents expire and other companies can copy the drug, it can mean a patent cliff in revenue. Blockbuster drugs can account for a big chunk of a company's sales. Humira alone was 32% of AbbVie revenue when it lost its patent protection last year, resulting in an immediate loss of $4 billion in sales and ongoing competition. So then that decreased spending on drug development by the majors is only going to make the patent cliff worse, threatening revenues even further. It looks like Amgen, ticker AMGN, has the most to lose, with 67% of its revenue at risk to that patent expiration. Following closely is Bristol Myers, with 63% of its revenue at risk, including both $12 billion Eliquis and $8 billion Opdivo, which lose protection from 2026 through 2028. Shares are down more than 20% over the last year, and revenue is already expected to fall next year. Among the relatively safer stocks could be Gilead Sciences, ticker GILD, with just 24% of its revenue exposed to those patent expirations through 2030, and AbbVie, ticker ABBV, with 29% of revenue coming off patent expiration over that period. But with any threat to a group of stocks, there is also an opportunity. That's because the primary way Big Pharma plugs holes in its pipelines when companies just aren't spending enough to develop those drugs themselves is to buy new drug discoveries. Analysts at Morgan Stanley estimate the major drug makers have $383 billion set aside for acquisitions, and that could mean outsized returns for 7 stocks I'm watching. First up, one of the smaller stocks on the list, Mirum Pharmaceuticals, ticker MIRM, at a $2 billion market cap. Mirum is a biotech focused on rare liver diseases with 4 approved indications and 4 in late-stage trials that could boost growth even further. The company reported Livmarli sales up 45% over the last year to $47 million and reaffirmed its full-year revenue guidance to between $310 and $320 million. That would be a 69% higher from last year. Now that very strong revenue growth of 69% this year is expected to slow to 28% next, though that still takes the company to $400 million in revenue. Mirum is still expected to post a loss, but that negative earnings is expected to plunge to just 79 cents a share from nearly $4 a share last year and could go positive within another year. A recent label expansion for Livmarli to older patients could fuel more growth next year, with another study starting in the second half to expand it into another indication. The company's pipeline in 3 other drugs and 4 indications should help further continue that growth over the next few years. Now, a critical piece in analysis for these biotech stocks, especially the smaller ones like Mirum, is the cash flow statement. Most of these are going to be cash flow negative in operations and for free cash flows. That's the operating cash flow plus some investment spending. It's hugely expensive to research and develop a new drug, which is why they're so expensive, and patents protect sales for a long time. That said, the company needs balance sheet cash to survive and pay for that R&D until it gets products through testing and revenue catches up. You see that in this end cash position row, and you see that while Mirum posted an outflow of $23 million in operational cash flow, along with spending of $250 million investing in R&D, it still has $233 million in balance sheet cash. Combined with more capacity for debt, that should hold it over while revenue and earnings grow. We're just getting started on our list of stocks to buy, but if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. These are the stocks I'm following in major multi-year themes, with one of the picks up 100% and the group up an average 94% last year alone. That report is totally free. You're going to see the first stock immediately, and they'll email you the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link below. Sarepta Therapeutics, ticker SRPT, is one of the larger companies on the list at $13.4 billion market cap, but with some strong drugs in its pipeline. The company just recently received an expanded approval from the FDA for its muscular dystrophy drug Elevidys, a drug that is expected to add another $2 billion to annual revenue within 2 years. Beyond that blockbuster, the company also has several other trials ongoing in RNA-targeted therapies, gene therapy, and gene editing indications. As it stands, revenue is expected to jump 41% this year and 78% next to over $3 billion, with earnings up 605% as the company's 4 drugs take it to another level. Like most biotechs, this one has a history of big ups and downs as those drug trials are approved or declined by regulators, but the company is constantly improving its discovery process and already has some very good acquisition targets. Another stock I'm buying on the theme is Recursion Pharmaceuticals, ticker RXRX, for what could be a revolution in drug discovery. Recursion is leading in the race to decode biology and recently announced its language model orchestrated workflow engine, or LOW, to perform complex drug discovery tasks using a natural language interface. It's doing this by running experiments through purpose-built AI models on massive datasets, enabling it to screen and find the compounds that won't work, basically to fail faster, so it spends less time and money developing those drugs that aren't going to work. So through this use of AI, Recursion could dramatically lower costs for drug development, an advantage that would be worth tens of billions to big pharma companies. The company has 6 programs in pipeline trials for 7 indications, 4 of which are in phase 2 and expecting results within the next 2 quarters. NVIDIA recently invested in the company with a $50 million equity investment and is providing priority access to its hardware and resources. Recursion also has research partnerships with major healthcare companies like Bayer and Genentech, driving $58 million in sales this year. The company is also still posting negative earnings and is actually expected to see those losses grow as it spends more on development, but revenue growth is high enough for that risk. Sales are expected up 60% this year and 25% next to almost $90 million. But cash flow is a bigger question mark here than with our first 2 stocks. Operating cash flow has progressively gone deeper negative as the company spends more on its models. It borrowed heavily over the last year, adding $400 million in debt to cover that cash flow, and still saw negative free cash flow of $345 million. Still, the $483 million in balance sheet cash and strong interest in what AI could do for drug development should provide financing for the company as long as it needs. We've still got 4 stocks to highlight, including a way to get the upside potential on the entire theme without having to pick individual stocks. But first, I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of the community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Another stock in that AI drug discovery theme is Schrodinger, ticker SDGR. This one's smaller at just $1.5 billion market cap. Schrodinger is supplementing its own drug discovery revenue by licensing out its software, which brought in $159 million of the total $216 million revenue last year. That's helping to minimize the cash burn while it develops its own pipeline along with 17 collaborations, including Eli Lilly, Genentech, and Bristol Myers. Schrodinger doesn't have the expected growth we saw with Recursion, with negative revenue growth this year before rebounding to 20% next. Earnings are also more deeply negative here, so this is the riskier of the 2 AI drug discovery stocks. Cash flow is a bigger problem here as well, with the same increasingly negative outflows, but also a smaller end cash position to cover those future outflows. The reason I'm including Schrodinger in our list, beyond that strong interest in AI drug discovery that could make this a 10-bagger stock still, is that much of the bad news could already be priced in with a price-to-sales valuation of just 7.4 times. That is considerably cheaper than the 33 times price-to-sales investors are paying for Recursion right now, so any good news for Schrodinger could see a jump in the shares. Really, the biggest problem in this theme, buying those biotech stocks and potential takeover targets, is that you almost need a PhD or experience in the industry. Take a look at the analysts covering pharmaceutical stocks and biotechs, and they almost all have deep experience in either healthcare or pharmacy. That's what it takes to really understand the process for drug discovery and clinical trials. One way around this for Main Street investors is to buy a broad-based ETF like the SPDR S&P Biotech Fund, the XBI. It's the largest and really the go-to ETF, holding 134 companies, and will give you some of that upside potential to the acquisition boom in Big Pharma because these are going to be the companies acquired. Now, the big drawback to the XBI is the stocks in it are themselves giant companies with an average market cap of $32 billion, so I'm afraid most of them are too big to be bought out, and even a strong buyout trend may not move the ETF as much. It's still a great way to get that broad exposure to the theme and will do well. Another ETF you might check out is the Virtus Life Sciences Biotech Clinical Trials, ticker BBC, which has 2/3 of the fund in small or mid-cap biotechs, so very much smaller companies that, were they to be acquired, would see a bigger move in the fund. It's a very small fund and very high expense ratio, so maybe more helpful is just using it as a place to start your research, going to the top holdings and seeing what stocks it's buying to find ideas for your own portfolio. We've still got another stock to highlight, one that I just bought researching this video, but folks, with the coming election and rate cuts, one thing is certain: stock market volatility and uncertainty is back. Fortunately, I found 7 stocks that actually win during market chaos, 7 stocks that need to be on your radar, so make sure you watch this video next. I hadn't seen Amicus Therapeutics, ticker FOLD, before researching for this video, but it's definitely one to watch in the theme. This is still a relatively small biotech at $3.5 billion and concentrated in 2 approved therapies. It's Galafold for Fabry disease and the recently approved Pombiliti plus Opfolda, a 2-component therapy for late-onset Pompe disease. The company reported second quarter revenue up 34% over the last year, beating estimates, and raised its guidance for Galafold sales for the second time this year. Galafold now has 60% market share for its indication, helping the company reach non-GAAP profitability in the first half. Amicus also guided to 490% sales growth in its recently approved Pombiliti and Opfolda therapy, suggesting a very strong launch. Growth targets for Amicus aren't the highest of the group, but it is consistent with 29% sales growth this year and 23% expected next year to $640 million. Even better is this one could turn GAAP earnings positive next year, which would be a big driver for investor sentiment. And even more to like, besides the decreasing negative cash flow, the company has plenty of cash on hand to cover it. Amicus closed out the last quarter with over $200 million in cash against an operating cash deficit of just $42 million over the last year. It can fund that growth for years at this rate as sales catch up and earnings go positive. See the stocks I'm buying for the next 30 years, my forever stocks, free but only with the link in the description below. Or click on the video to the right for the 7 stocks that win on market volatility. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.